Edutrainment Workshops, the insurance industry's leading education and training platform, presents Life Insurance, the entry-level series, the products, the underwriting, and the planning applications to position your practice as the premier provider of insurance products in your community. Get on board, get on track, get to where you're going. And now, your Edutrainer, national insurance columnist, Steve Savant.
Well, welcome everyone. My name is Steve Savant and I'm your Edutrainer or coach for our Edutrainment Workshop series, and we're doing our entry-level introduction into annuities. And if you've missed any of our classes this week, just hop out to our website at www.brokersalliance.com. As soon as you come to our homepage, all you have to do is click on the on-demand button and you can be brought right into the archives and catch up. And I really recommend that you don't drop into the class in midweek. Try to get always at the beginning and take the course, because I kind of build on concepts and ideas. Yesterday, I spent a significant amount of time talking about basic vocabulary concepts. If you want to order the complete vocabulary, just write me thebiz at brokersalliance.com. That's THEBIZ at brokersalliance.com, and I'll be happy to send it to you. Now, I want to go to the board, the Mondo pad here, and it's such great technology. And I'm looking at a basic piece that we pulled off of the top #1 site for indexed annuities called annuityspecs.com. And you might know the person who designed it, the construction. She's excellent. She's one of the top people, Cheryl Moore. She's known as the goddess of all that's indexed. And on her site, she has an excellent introduction basic piece that I really like. And I'm going to be using some of this in our tutorial, so a little kudos to her. But more than that, when you look at some of the ideas and the concepts of this, this really helps you understand, I think, a lot of the basics. Now, let's just go into it now. I'm going to assume a little bit that everybody usually hears about life insurance, but I'm really surprised in the public domain, when you think about a retail client, they have not heard annuities, even though it's surprising to you and I. And yes, there's been a lot of bad press about annuities, and you'd think people would see that by now. And there's a ton out on the web on all this. However, I still have to explain annuities. Now, most people know basically life insurance is for when you die, they'll give you a lump sum. The trade-off in annuity land is generally you're doing either payments or a lump sum in to receive payments that you can't outlive. So it's reverse, or it's an inverted thinking. It's a mortality product, as I told you yesterday. And when you think about it, I'm trying to make sure that there'll be payments either fixed or for my lifetime, so that I can never run out of money during either the period that I choose and or my lifetime or the lifetime of my wife or my beneficiaries. So I have the ability to go ahead and look at this, but every product has different risk and reward trade-offs. And I want to talk a little bit about this because it really matters. I have risk and reward trade-offs, but before I get into how that works, you have to look at the timeline. How long do I have to hold? An annuity is a hold position. You shouldn't completely liquidate your portfolio and purchase an annuity. You may need emergency money. You may be laid off. You may need 90 days, maybe even 180 days of actual money and liquidity. Now, annuities do give some liquidity, but depending upon your age, you might have to pay tax on that liquidity as well as a penalty. So just want to be careful how we do that. Now, when I'm looking at basic premises of annuities, I could buy a fixed annuity, an annuity that has a lockdown rate. That rate is for a time certain. It has surrender charges to it. I have to find out, is the rate worth it? For example, risk and reward. I have an annuity today at present day in August 2012. I looked at the annuity spreadsheet. I can get 3.6 lockdown rate for 10 years. But I'm thinking, wow, that's pretty good. But I still think interest rates are going to move up over the next 10 years. And for a little bit less, 3.2%, I can lock down for 5 years. Now, hear the difference? I have a 10-year at 3.6. I have a 5-year for 3.2. That's 40 basis points. Do you hear the difference? Because I want you to understand, is it worth it for the extra 40 basis points to lock it down for 10 years? Most people would say you're risking upward trends in interest rates. So in this kind of environment that we've been in so long with low and suppressed interest rates, we kind of feel like sooner or later, we're going to have to go ahead and undergo inflation. We've been printing money now, as the government has been doing, and we're going to have to sooner or later have interest rates go up. So if I'm using a fixed annuity, I'm going to look at the basic premise of, is it worth to go out 7 years, 10 years? Probably not. The spread between the 5-year rate and the 10-year rate is only about 40 basis points, not even 0.5%. So most people are of the ilk, from an advisor point of view, let's keep it on a short term, 60 months. That's what I'm looking for. Now, when I'm doing indexing on annuities, I'm always asked about the cap rate, because remember, they're going to put a certain limitation on how much I can make. But let's talk about the first part of the fixed annuity was preservation of principal and a lockdown rate. But I like about index is preservation of principal, and they have a guaranteed underpinning number or a rate. If you hold for the whole period, it's very low, but it's still guaranteed. And the best part is, can I participate in indexes? Some of those indexes could be the ones we know, Dow Jones, S&P, NASDAQ. Those are domestic indexes or indices. It could be foreign, the Hang Seng, the Euro 50, all these, the Euro Stock 50, all these are foreign. So you would be able to say, what do I think? Do I think the foreign indices are going to be better than domestic or the United States? And so right now you'd be able to pick on that and say, how long am I going to hold on this? And in my view, it's very tough. I know there are indexes at 5 years, some even a little bit lower than that, not much though. And 5 years is kind of the short term. To me, that I'd rather probably play, if I was going to go 5 years, I might just say 3.2% in the fixed in a 5-year platform, call it a day. Whereas if I had indexing, the moment I get past that 7th year, that 10th year, I think indexing is going to be the way to go. Now, if you're a fan of the S&P, the S&P would say over the last 2 20-year periods, we've been able to sit there and look at an average S&P of 5.5%. Now, when you look at that kind of return, you can kind of say 5.5% pretty much in those 20-year periods. The longer I can hold, numbers like that have a chance, remember, have a chance of becoming reality. It's not a guarantee. And another thought about the dividend, about the issue of S&P 500 and all indices is that these products do not participate in the S&P 500. Now, that's an indexed. If you had a variable contract and you were just buying S&P side funds, whether it's life insurance or variable, you would pay a small charge for that, whatever the management fee is, but those participate. So you could have an S&P in that regard. So depending upon how long you're going to hold it and what's your risk. The giveaway is on fixed and market valuation adjustment annuities. And everything I'm saying is it has nothing to do with surrender charges yet. We'll get to that in a moment. When I look at the basics here of fixed market value annuities or index annuities, all those have a preservation of principal to it. When I go into variable land, I have to make sure the contract gives me a guaranteed death benefit or a guaranteed floor so that my principal or my basis or my corpus or my original contribution always has a chance of staying level. And to pay for that, you may have to buy certain allocation models that try to protect principal. So you just remember, you have to stay in it long enough, and they actually may even have income riders, whether it's indexed or whether it's variable. But remember what you're getting as you're moving down the line of risk now. And so you got to remember, you could lose principal. And unless the contract says different in a variable contract, you want to still look at that. So it's fixed rates, indices, and equity markets in variable. You want to start looking. Those are your three. And what I want to do now is take you to a chart and just show you the basics of how I lay out risk and reward. Okay, let's go to the Mondo pad. And what I have here is I've laid out a grid, basically of the annuity risk and reward spectrum. Kind of a basic idea. It's a basic one. And I've laid out fixed annuities, I've laid out index annuities, and variable annuities. I've talked about guaranteed interest, and notice in variable, you could actually buy a variable contract. I think it'd be expensive to do so, but you could buy a contract that actually has a fixed account that actually does guarantee a return, but that's the only thing that it guarantees. Now, let's just go through this just to make sure we're all on the same map. Fixed traditional annuities, they may have typically a 2% floor right now. Again, if it's short term, it may be less than that. And it also does it have upside potential? Very limited, unless it says otherwise. Right now, even though this says the grid shows a little higher than that, right now the grid best one I saw for a small, probably a 5-year rate is probably 3.2% 5-year lockdown and 3.7%, or I think it was 3.8%, somewhere in that vicinity, for a 10-year lockdown. So then there's no participation in it, and the risk for the client is low. The only risk exposed in a fixed annuity generally is the carrier who's behind it. And we're going to get into that next week and talk about carrier ratings. How do you judge that? How about the balance sheet? I like this company, but they're lower rated. Is their balance sheet still okay, Steve? All those kind of things is what we have to look at. And so when I look at fixed, I'm looking at the guaranteed interest, not much upside potential. Whatever the rate and the time is, it's a lockdown. Then when I look at the index, there's no participation, but it has low risk. Now, when I'm looking at an indexed, my guarantee is going to be somewhere around 87.5% of 3%. So it's really limited, of the premium. And that's 87.5% of the premium at 3. So you have to remember that it will be a little bit, it's better than nothing. I always have that at the bottom. I'm not going to lose anything on that. And my upside potential is limited generally to whatever the cap is. Now remember, a lot of these index annuities, as an example, are going to have caps, and caps are pretty low right now. Although at the time that we're filming, there's actually a carrier, if you're willing to hold past 10 years, we have a carrier that's actually showing a 6+ index cap right now, which is pretty good. And if you're a long haul thinker and you think that rates are going to kind of stay suppressed and you'd like to say, hey, I'd like to take a shot at that cap, I think S&P is going to perform around 5.5%, 6%. Hey, that could be a good deal. Gains are based on the performance of the external index. Remember, whatever index do you think the United States is going to do great, then you're going to be sitting there in the S&P, the NASDAQ, or something like that. Something like that. You could be doing foreign if you think that foreign markets are going to do better. Just remember, make sure the contract has a lot of these guaranteed provisions in it. A lot of them do, but I always say, always check. And if you ever have a question on the actual explanations of this, we have some of the top authorities in indexing to be able to get on the phone with you and walk you through the contractual imperatives. Lastly, variable. I've been licensed in securities for a long time, since the mid to late 80s. And variable contracts, even though they came into 1952, they were actually brought into the market. We really didn't get into them until the early 90s. But in the 90s, they brought these on. And again, if I felt like I was wanting to get serious exposure with no limitations or no caps on my growth, and like in the S&P's idea, participate even in the dividends, and I was willing to pay the expense loads for that, that might be the way to go. If I felt the market was going to be tough and rough on me, I might be able to move into the fixed account. Every account has their provision. Can I do it once a year and I have to stay there? Can I get in and out? Depends, because there's no such thing as market timing using variable annuities. I don't believe in that, and I don't think the liquidity issues and the moving back and forth from the fixed interest account is really worth trying to play that game. But every so often, if you say, but I just got to park it, my psychological behaviors can't take it anymore right now, the market's too crazy for me, I'm going to sit and fix. So you could do that. But generally, I'm looking at variable contracts for younger people who have a longer haul to go, and they really see this as, I know that over the long period, the S&P, being involved in the equities, being involved in the stock market, is going to be better than other choices, and I think I'll do a better job. The younger and the longer the timeline, the more I'm interested in this. Another thing that I might be interested in variable is it may have also probably the provision to be able to give me guaranteed income and guaranteed death benefit. But remember, indexed has that as well. So you have to play out in your mind, especially as the one I alluded to earlier, with a 6% cap, maybe index is the way to go. Then you don't have to worry about any of the issues of having a rough market like it is in variable. Now, what I want to do is I'm going to walk back and I'm going to talk a little bit about when we look at variable, when we look at index, when we look at fixed, I want to be able to say, who sells this product? Now, this is so weird because at the bottom of this caveat, it says, any salesperson that suggests, and the reason I'm bringing up and kind of getting on indexing for a second is because we see this a lot. It says any person that suggests that index annuities provide unlimited gain potential either misunderstands or misrepresents the product. All these have certain caps or participation rates. What you have to tell your client is this is the ceiling. You need to declare it, you need to tell the client and expose them to the contractual provisions, and remember that caps could change every year. So when I'm choosing a company, I want to choose one that has good renewal rates.
This has been an Edutrainment Workshop, the educational division of the National Insurance Clearinghouse, the marketing arm of Brokers Alliance.